By the end of next year, 3 out of every 4 mortgages in Canada are going to be renewing. So if you have a mortgage, imagine finding out that your mortgage payment is going to be increasing from $500 to $1,000 per month. You didn't move homes, you didn't buy a bigger home, you didn't upgrade your home. The only thing that happened is that term that you signed came to an end. And now you're facing potentially higher payments, but you also have a weak economy, a tighter job market, an ongoing and unpredictable trade war, and we have a government that seems more interested in spending money overseas than they are in fixing problems here at home. So that's the scenario thousands of Canadians are going to be experiencing. The thing is, these mortgage terms are already set, so the clock is ticking. This isn't anyone's opinion. And the impact of all this isn't just going to hurt those homeowners. This is going to have ripple effects through the entire housing system throughout the country. So today in this video, I'm going to break down a couple things. The first one is why so many Canadians are renewing at the same time. It doesn't seem normal. 2, what those new payments are going to look like for some of those Canadians. The third one is some of the risks that some of the families and investors are going to be facing with all these renewals. And the last one, and most important, are the options that you have to protect yourself. So during COVID and just after COVID, Canada had historically low interest rates, which means money was very, very cheap. And that meant millions of Canadians got mortgages at really, really good rates, some as low as 1.5 to 2%. But now if you fast forward a few years later, those same people, those same mortgages are coming up for their renewal. And right now, rates are trending anywhere between 4.5% to 5%. And you might say, hey, this is completely normal. It's common for rates to go up and down and return to a bit more normal environment, which I agree with. But the amount of renewals we're seeing in such a condensed period of time is not normal. So let's take a quick look at the math here. If you took out a $500,000 mortgage and you locked in, let's say 1.8%, your monthly payment was just over $2,000. Fast forward to today, that same monthly payment at a 5% interest rate is going to be close to $3,000. So that's anywhere between $800 to $1,000 every month for the exact same home. You didn't upgrade, you have no renos, you're not moving, there are no changes. You're not getting anything in exchange for that money. Now, you might be thinking, well, hold on a minute, we were all stress tests to ensure that we can afford those higher payments to solve for this exact problem. And you would be right, when people got those mortgages, they had to prove that they could afford payments at either their contract rate plus 2% or the minimum qualifying rate in Canada, which is 5.25%. And you have to go with a higher one. So in theory, that buffer is supposed to protect families from this exact problem. But the issue is that test was based on their income back then and their expenses back then. Since then, we've seen inflation go on a wild ride, which has started to eat away at that safety buffer. Another thing you need to consider or think about is wage growth. Since 2021, on paper, Canadian wages are up. But once you factor in inflation, it's a different story. After inflation, believe it or not, Canadians are actually earning less than they did back then. Our nominal wage growth has risen about 4 to 5% per year since 2021, but real wage growth, once inflation is factored in, is actually 1 to 2% below 2021 level. So what this means is the number on your paycheck is going to be bigger than if you compared it to 2021, but what is affected is your purchasing power with those same dollars. Another consideration is obviously the expenses, and since 2021, the overall cost of living is roughly 14 to 15% more across the board with consumer prices. Groceries alone are up over 20%, which marks one of the steepest increases in decades. Other consumables like utilities, gas, insurance, not to mention the cost of construction, have all climbed considerably above our wage growth. So even though those borrowers, those mortgage holders passed the stress test back then, most of those families now are walking into renewals with way less buffer in their budget. What that means is the majority of Canadians with a mortgage now will be forced to reset their payments at a higher rate, which could mean a higher monthly payment. And the unfortunate thing is most don't have the extra income to cover those bills. A lot of bills are going to increase across the board without families getting anything in exchange for that outlay. So a lot of their bills are going to increase without families getting anything in exchange for that money that they're going to be spending. And here's an extra layer to it that makes it worse for a small select group. Not everyone has been paying down their mortgage loan the way that they think they have. A somewhat small portion of borrowers back then chose a variable mortgage, and of those variable mortgages, they chose fixed payments. By 2023, roughly 1/3 of all Canadian mortgages were held variable, and about half of those chose variable with fixed payments. So the way those work is as interest rates climb, more and more and more of the fixed payment, the total fixed payment, goes towards interest instead of principal. And the thing is, many of those borrowers have already hit their trigger rate where almost the entire monthly payment is going exclusively to interest. What this means for those borrowers is many have barely scratched the surface on what they owe. Others might actually be in what's called negative amortization, which means they owe more today than they did a few years ago. Now, the claims are the worst is yet to be felt because the majority of these renewals are coming in 2026. We are starting to see signs early on. In British Columbia alone, missed mortgage payments have jumped more than 60% since pandemic. And in Vancouver alone, missed payments are up more than 20% in the last 12 months. So this isn't trying to scare anyone. This is simply the reports. It's the numbers, because families in BC are starting to fall behind and there's a big wave of renewals that are still yet to come. The truth is Canada just hasn't seen this many renewals condensed into a time like we're experiencing now. Really, really low, historically low rates, renewing into more normal but what feel like very, very high rates. Coupled with inflation, their budget is just feeling a lot tighter. So what does this actually mean? Well, for families facing a $800 to $1,000 jump in their monthly payments, they might be forced to sell. And with investors, some may be barely breaking even. They may be looking at their cap rates as renewals eat into their cash flow. They too might want to offload those properties. We've seen with buyers are sitting on the sidelines and they're waiting for prices or rates to go down, which all puts downward pressure on real estate prices. And as an example, we're seeing it across the board in British Columbia condos. Now, most importantly, banks are starting to see this too. What they've started to do is respond to it with tightening their new approvals. They're also pulling back on home equity lines of credit, and they're setting money aside, loss provisions. They're setting money aside for their losses. So in a really simple way, what they're doing is they're budgeting and they're expecting a portion of Canadians to default. But the good news is, if you're renewing this year or next year, you don't have to sit and wait. There are options for you, but my biggest recommendation is to start early. You could have a free discovery call with a mortgage broker of your choosing, but the earlier that you start, the better your strategy and the better your execution will be. And really, the more options you have. Now, you do have a couple options if coupled together could really make a solid plan. Instead of facing such huge payment shock, some people are extending their amortization back up to 25 or even 30 years if they qualify. And what that does is that softens that monthly burden, right? You will pay more interest in your mortgage, but in Canada, we have those 2, 3, 4, or 5 year terms. So if you're feeling the tightness now, you can extend your cash flow by extending your amortization. The second one, which isn't for everyone, but what you can do if you are carrying higher interest debt than your mortgage, you can actually roll that debt into your mortgage. That's going to help you potentially cut hundreds of dollars of monthly overhead that is going to high interest debt. I know this all sounds doom and gloom, but the cool thing about my position is we're able to help families that feel like they have no option. We have the option to restructure your mortgage, restructure your financial plan into something that is manageable. So if you start early, you're going to be able to protect your home, protect your monthly cash flow, and therefore your family's future. So guys, if this video did help, do me a favor and subscribe. I'm always trying to improve. If you guys have questions, send me a message, book a call, and I look forward to talking to you again.